Do you know that the IRS has increased the tax brackets for 2023? It also implemented the biggest increase in standard deduction amount since 1987. That means you can pay fewer taxes in 2023. So how much will you save and how should you take advantage of it to speed up your financial independence journey? That's exactly what we're going to talk about today. You'll also get an update on our old friends, Mr. and Mrs. Goodman, Mr. and Mrs. Aspire, and Mr. and Mrs. Dream. So make sure you stay till the end. Hi, I'm Prudence Zhu, CPA and financial planner. I provide tax and wealth strategies to professionals and small business owners. So let's dive right in. First, we must go over the concept of progressive tax. If you are familiar with it, feel free to jump to the next chapter, where I go over the adjustments for 2023 and the implications. The US uses a progressive tax system to calculate individual income taxes. It is also used in many developed countries in the world. It means that the more you make, the higher your tax rate will be. It is opposed to a fixed rate system, meaning you pay the same percentage in tax no matter how much you make. The income tax in the US is calculated by brackets at different rates. For example, Mr. and Mrs. Aspire make $135,000 in 2022. Taking the standard deduction of $25,900 for married couples, assuming no other adjustments, exemptions, or credits for now, they will be taxed on the $109,100. Out of that amount, the first $20,550 would be subject to 10% federal tax. The next $63,000 would be taxed at 12%, and the last $25,550 would be taxed at 22%. So they owe the IRS $15,236 in income tax for 2022. And if you divide that number by their household income, you'll see that their effective tax rate is 11.3%. Whereas their highest marginal tax rate is 22%. That means if they made $1 more, they will have to pay 22 cents more for income tax. You might have heard people say that a promotion will put them in a higher tax bracket and they would pay a lot more tax. That is only partially true because the portion over the previous bracket's maximum limit would be calculated at the higher rate, not the entire income. So make sure to distinguish between effective tax and marginal tax rate, because applying your marginal tax rate to your entire income would significantly overestimate your tax liabilities. It is also important to remember that the highest marginal tax rate is relatively low compared to history. Currently, it is 37%. It was as high as 94% right after World War II, 70% in the 70s, and 50% in the first half of the 1980s. Past data show that whenever the maximum marginal tax is low, the real income of the rich grows much faster than that of the poor. Whether the low maximum marginal tax rate since 1987 contributed to the income disparity is a topic for another day. Besides the IRS, 32 states in the US also use a progressive tax system. And if you live in one of these states, it's most likely that the tax bracket limits in your state have been adjusted in your favor in 2023, which could generate some tax savings on your state tax as well. States where the highest marginal tax rate are over 10% include California, 13.3%, New York, 10.9%, and New Jersey and Washington, D.C., both at 10.75%. So residents in those states might see the most significant savings in 2023. Let's go into the details of the adjustments now. Every year in October, the IRS publishes the tax limits for the following year. It is a way to lessen tax burden while prices keep rising, so that taxpayers can avoid paying higher taxes if their standard of living or income level is only keeping up with the inflation. The adjustments might include tax rates, tax brackets, standard deductions, contribution limits and rules for tax-advantaged accounts, all kinds of phase-outs, and the list goes on and on. This is also important for tax and financial planning professionals like me, because that's when we start teaching our clients about the changes and the implications for the following year. By now, we know the updated tax information for 2023. What would impact most people are tax brackets, standard deduction, and 401k and health savings account HSA contribution limits. Here is a comparison of 2023 versus 2022. There is no change in the tax rates, still ranging from 10% to 37%. However, the upper limit of each bracket has increased by 7% across the board. This increase is a bit higher than in previous years, and that's due to the high inflation in 2022. Moving on to the other categories. For example, the standard deduction, which is the amount you don't have to pay tax on each year, will be increased by 6.9% in 2023 for both single taxpayers and married filing jointly. 401k contribution was increased by almost 10% to $22,500, and the catch-up portion for people 50 years old and above has increased by 15.4%. If you qualify, you can contribute up to $30,000 to your 401k retirement plan in 2023. And the contribution limit for health savings account or HSA, which is a triple tax advantaged account, has increased by 5.5% for individuals and 6.2% for families. However, the catch-up portion stays the same, still at $1,000 for people 55 years old and above. If you are interested in learning more about tax-advantaged accounts and how you could benefit from them, I have a separate video and I'll include the link in the description below. Now you have a good idea of the positive tax adjustments for 2023. If you are an employee, you don't have to do anything because your employer will most likely adjust your tax withholdings. But if you have side hustles, or self-employed, or run your own business, you should talk to your CPA or tax advisor about adjustments to avoid overpaying estimated tax payments in 2023. More importantly, let's talk about how to stay on track, or even speed up your financial journey in today's shaky economy. Year to date, the S&P 500 has gone down by 20%. Bitcoin lost 54% of its value. Tesla is down 41%, and the S&P US Aggregated Bond Index is down 15%, and even gold is down 10%. In addition, inflation was at a 40-year high in September, and some tech giants have announced job cuts, and probably many more companies would follow suit. Anxiety is building and spreading, so what can you do about it? Instead of worrying about things you can't control, it's better to shift your energy to the things that you can change. For example, accept the reality of the economic downturn, plan for it to continue for another couple of years, focus on building your skills and wellness, have confidence in your long-term strategy, and save and invest wherever you can. By doing something consciously and planning ahead, you would gain some control and not panic when the unexpected things happen. And that's why I'm recommending my clients continue to maximize their tax-advantaged accounts if they can, build an emergency fund, and continue to invest using dollar cost averaging. I also have a video on that topic, and I'll include the link below. Now, let's take Mr. and Mrs. Aspire, for example. With a household income of $135,000, if they max out their 401k and HSA contribution versus no contribution, they will save $8,115 on federal income tax in 2023. Those savings would show up as additional shares in their tax-advantaged accounts and speed up their wealth accumulation in the long run. Seeing your net worth grow usually provides confidence and builds a positive feedback loop for most people. And down the line, when they approach retirement, there are many tax planning tactics available to reduce their taxes, and I will go over those in future episodes. If they used the same strategy of maximizing tax-advantaged accounts in 2022, they would save $791 in taxes in 2023, thanks to the IRS tax adjustments. And for Mr. and Mrs. Goodman, with a household income of $67,500, their tax liability would be $1,518 in 2023, saving $235 compared to 2022. And they would save even more if they contributed more than 25% of their income into their 401k accounts, which would be recommended if they don't have any other short-term needs for money. As for Mr. and Mrs. Dream, they would save $2,371 in federal income tax, and their highest tax bracket would drop from 24 to 22. To estimate how these 2023 tax adjustments would impact their financial journey, I updated the 1 million wealth accumulation model for all three. If you are new to my channel, there are three couples prioritizing their financial freedom with a different income level. They are double income households. They consistently invest in themselves to increase income, maximize tax-advantaged accounts, invest additional after-tax income in S&P 500 index fund, and buy an average home and another investment property to diversify their asset allocation when they can afford to. With the previous model, using 2022 tax information, they would accumulate $1 million in net worth in roughly 13 years, 9 years, and 7 years respectively. And with the 2023 tax limits, they would accumulate wealth faster. The biggest winner would be Mr. and Mrs. Aspire, achieving $1 million 4 months faster than before. This means if the dollar thresholds are the same, they could achieve financial security and freedom 4 months sooner and retire earlier. Mr. and Mrs. Dream would also hit all their net worth milestones 2 months earlier. And Mr. and Mrs. Goodman would reach their milestones a month earlier. You might ask, if all three couples contribute more to their tax-advantaged accounts, wouldn't they take home less, which may not be feasible in today's market when everything is getting so much more expensive? It's actually not as bad as you think. After the tax savings, Mr. and Mrs. Goodman's take-home pay would be $10 less per month. Mr. and Mrs. Aspire, $333 less, and Mr. and Mrs. Dream, $288 less. If that seems hard to achieve, especially if you have various financial responsibilities, I will discuss how to save in style in my next episode. So please subscribe and make sure you don't miss it. To summarize, the IRS increased tax limits for 2023, and you will most likely get some savings. The best way to leverage those changes is to maximize contribution to tax-advantaged accounts and keep investing. Rising anxiety and sense of security are understandable in today's economy. Taking action on the things you can control will lower your stress level and accelerate your financial independence journey in the long run. I hope today's episode inspired you to optimize your taxes and plan for the life you want. If you liked it, please give it a thumbs up and share it with others. We're also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel to learn more tax and wealth strategies to build the life you want. See you next time!